Okay, good morning, ladies and gentlemen. Sorry for that short delay. Couldn't find the button. Um, I just want to check if you can hear me before we start. Let's do the normal sound check. If you can hear me, if you could please just find the button where you raise your hands. There's a button on your screen somewhere that you click and then you raise your hands. Okay, I can see only one or two hands. Okay, now there's more coming on now. All right, so it looks like you can all hear me, so we can get started. Thank you. Okay, as you can see, this morning our topic is control risk assessment. My name is Henk Heymans. I'm the head of audit at RSM South Africa. The last time I talked to you, or a year or so ago, I was still at ProBeta, and now I'm in the profession, and I am now going to talk to you, I think, from a more practical point of view. Control risk assessment, specifically relating to probe. I just want to quickly set the scene. If you can just have a look at the screen. This is a slide that is, the slide is taking a while to come up. I'm just going to wait. Okay, this is a slide that I took two slides straight from the IFAC SME audit guide. By the way, if you want to do yourselves a favor, if you want to understand how these things really work, pick up a copy of that IFAC SME audit guide. You can just go and search for it or go and get it off the IFAC website. There's two volumes. The one is more the theory and the second one is the application. It takes you through two case studies and it contains very useful slides and material and explanations like this one. The reason why I brought this slide in is there's a common misconception that you assess your inherent risk and then you assess control risk, and control risk adds to inherent risk. So as you go, as you find more risks, you add and add and add and add until you get to a massive risk and you need to mitigate that. It's not true. If you look at the direction that the arrows go in this slide, you can see that sorry, I see I cover up some of your slides. I just want to change this quickly. Sorry, just a moment. Yeah. Looks like the screen is not working on all the computers, so let's make sure it runs. Yes, now we are. Now we're up and running. Sorry about that. Okay, now you will understand what I'm talking about as well. Look at the direction of the arrows. You'll see the top arrow is inherent risk. Inherent risk, as you find risks, it adds and adds and adds to your risk of material misstatement. And once you've found the risks, what is inherent risk? The risk of something going wrong. As you have found all the things that go wrong, that is everything that adds up to the red line, then you start looking for controls to mitigate those misstatements. So that's why they put the control risk arrow in green. So control risk now goes back to the side of mitigating the risk of material misstatement. And the difference between the two, so the things going wrong and the things not found, is the risk of material misstatement. And our job is to make sure that we limit the risk of material misstatement to whatever level is satisfactory. Just look at that slide. You might not understand exactly why I am making this point, but you will understand after the next slide. So I will come back to this slide and it will probably be in better context then. So the next slide that I want to show you is perhaps a bit more shall I say theoretical, because we're going to look at the standards. The terms that I use here as a starting point is what comes straight from the auditing standards. If you look at the auditing standards, in terms of our audit procedures, they distinguish between two types of procedures that an auditor can conduct in an audit. They've got risk assessment procedures and further procedures. These are terms that have only come into being about 10, 15 years ago. In the past, we had compliance tests and tests of control. It's not that. That's not what we're talking about. You'll see where that fits in a bit later. We've got risk assessments and we've got further procedures. For today, I'm only going to focus on the first block and only a section of that as well. So that's on the risk assessment side. If you look at the risk assessment procedures, let's just take you through the process of the risk assessment procedures. And this is the process as they are in the standards, as the steps are if you read the standards. I actually don't like to even talk about steps because it implies that it's a chronological process. It's not. All of this happens sort of at the same time and builds on each other and so on. So it's not quite a chronological process. But let's go through it like this. First of all, or not first of all, but the first one that I want to talk about is the inherent risk at the financial statement level. So you do an inherent risk at financial statement level. You then do a fraud risk assessment at financial statement level. All that financial statement level means is overall level. You do the inherent risk assessment and fraud risk. You consider what can go wrong at an overall level, not a specific line item level. We will get to that later. So that's what is meant by financial statement level. Then we take that same one, inherent risk and fraud risk assessment, and we do it at the assertion level. So first at financial statement level and then at specific assertion level. So not only do you go down to a line item in the financial statements, you also go further down and you look at that line item, but in specific assertions. That's what we did at the third box. The fourth box is control risk at financial statement level. So again, we start with the overall control risk assessment, and then we go to the specific control risk assessments. Control activities. Sorry about the abbreviation, otherwise the text gets incredibly small. So then you look at control activities, where the control risk at financial statement level was an overall level. Control activities are at a specific level. We'll do some examples in a few minutes and then you will understand what that means. I think this might still be a little bit confusing to those of you that are not 100% up to date with standards. Okay, and the rest we're not going to talk about, but basically I just want to complete the picture. But that is what is meant by further procedures. Further procedures, there are two types of procedures. That's your test of control and your substantive procedures. In fact, I will actually talk about test of control, but we will end there. So the part that we're going to talk about today is the control risk assessment. If we can take it back to probe. And as I said to you earlier, we can do this in any order that we like. It really doesn't matter. But we've found it makes more sense. It sort of comes naturally to do it at an overall level first. So to look at the overall risks, and then once you've got an idea of that, you've got a better understanding of the business, and then you go down to the specific level. So what we do in probe is this risk assessment procedures is section 11. Section 10 was pre-engagement planning. Section 11 is the risk assessment, and Section 12 is where you actually design your audit strategy and approach. So we're talking about Section 11 now. 1120 is where you do inherent risk at financial statement level. That is followed by 1130, control risk at financial statement level, followed by 1140, fraud risk at financial statement level. And you will see when you do this in practice why it makes logical sense to put it in that order, although, as I have said twice already, it's not important that you do it in that order. It's just logical. Once you've done that, you go into the specifics, and the specifics are done in 1150 and 1160. So first the specifics concerning control activities, and then the specific risks concerning inherent risk and fraud risk assessment. Just something that I just thought of. Please remember that everything that I just said applies to all entities. There's a common misconception that controls don't really apply to small entities. No. Everything on this slide is equally applicable to all types of entities. What might not be applicable to all entities is the control testing section. The test of controls might not, I'm going to try and highlight it so you can see what I'm talking about. There. The test of control section might not be applicable to all kinds of entities or all types or all sizes. But apart from that, everything is still applicable. So to emphasize, you still have to do a risk assessment. You still have to understand your controls. You still have to think about, are there controls that can mitigate it? Whether you want to place reliance on those tests will determine whether you want to test those tests. And that is a separate question altogether. You don't necessarily have to place reliance or test them. Okay, I hope that is clear. If it's not clear, get the recording and rewind it, and you will hopefully understand it soon enough. Okay, so if I can move on. The terms that we know for inherent risk and control risk, this is where they are addressed in probe. Okay, so you see inherent risk. Inherent risk is the inherent susceptibility of an item to misstated. What is the likelihood of it going wrong? Control risk is the likelihood of it not being detected by the controls. Okay. Um, and then, yeah, the rest is, I just added the working papers there, and that is just to show that will be addressed in the section, whatever, 10, 20, not 10, sorry, 20, 21, 30, whatever the section is. That's where those will be addressed. All right, so can I just go back to the slide that I had before? Hopefully you will understand it better now. Inherent risk is the risk of an error occurring. So the first thing we do is we assess inherent risk. Let me try and be creative. And it adds to your risk assessment. It makes the risk higher and higher as you assess it. So you find risks and you find risks and you find risks. So you carry on. Then for those risks, you look for controls. Now, yeah, I must tell you something really, really obvious, but I don't know if you ever thought about it. What is the sole purpose of a control? The sole purpose of a control is to mitigate a risk. You with me so far? A control is supposed to mitigate a risk. So, if there is a control that doesn't mitigate the risk, would you agree with me that that control is probably redundant? Well, from an audit point of view, it's redundant. There may be a reason why management has implemented that control. But if it doesn't mitigate a risk of material misstatement in the financial statements, we don't bother with it. It may sound logical to you, but many auditors forget about this. I see many auditors in practice going in, you get a new client, the first thing you do is go and do your control tests. So especially on a big audit, you know you're going to be under pressure when it comes to time of the deadline. So you go and do an interim audit and you do the control tests without doing a risk assessment. You can't do control tests until you know what the risks are, because then you're going to do unnecessary tests of controls. You're going to test controls that do not relate to a risk. And if you test a control that doesn't relate to a risk of misstatement, then you're testing something that, as I said, is redundant, and your whole test is completely superfluous. So you could have skipped that. More importantly than that, you are going to miss things because you are not driven by the risk. You are not looking at risk number one, what is the control? Risk number two, what is the control? If you approach it from the control side, then there's a good chance that you're going to miss some risks. So importantly, the first step, the red arrow, is to determine what is the risk of something going wrong. After that, your next step is, right, now for each of those steps, each of those risks, let's find something that can minimize that risk. Can I just ask you to mute yourselves? If you look on your screen somewhere, there's a mute button. Someone's computer is on and it provides feedback to all of us. Okay, thank you very much. Okay, so let me just recap. I think it's probably a good idea to recap anyway. If you do the risk assessment, that's that first red arrow. Once you've found the risks, you try to find controls that can mitigate those risks. And for every control that you find that mitigates the risk, you decrease your risk of material misstatement. Every control decreases the risk of material misstatement. Okay, I've spent 14 minutes now to set that scene and to put it into context. I hope you understand where the controls fit in. So are controls irrelevant to a small audit? No, absolutely not. Controls are very relevant. There are always controls that are relevant. And I find that as mainly, I can see on the list, there's mainly small and medium-sized firms here today. And in small and medium-sized firms, we've got a common misunderstanding of control. We don't spend a lot of time on control, so I'm going to spend just 2 slides now, maybe the third one also a little bit, just to quickly give you a breakdown of what basically the control components, the control structure. As I say, the small firms struggle with the big firms, and the internal audit guys, to them this comes as second nature. This is another slide that I have borrowed from the IFAC SME audit guide. I had the slide before, but I preferred these colors and the shapes, so I'm using this one. Okay, so internal control components, all that the internal control components are trying to achieve is to get our financial reporting right. That's what we're worried about. We want to make sure that the financial reporting, the financial statements are accurate, efficient, reliable, relevant, not efficient, relevant, reliable, all of those things. That's what we're looking for, the financial reporting objectives. Any control components that do not achieve financial reporting objectives are irrelevant to us as independent auditors. Obviously, the internal auditors and so on will bother with that. What I mean by that is something like, how do we make sure that there's no wastage on the machines or something like that? That doesn't achieve financial reporting objectives. Efficiency is not an issue to us as auditors. I mean, obviously, if you find something, you're going to report it, and if it results in a going concern problem, you're going to report it, but that's not of primary concern to the financial reporting objectives. We have to look at what controls are in place to achieve the financial reporting objectives of the client. Now, generally accepted practice is to divide your internal control components up into 5 different components. The one that we are quite familiar with, I think when we all think internal controls, we always think control activities. So that one I'm going to spend quite a bit of time on a bit later. But the others are often left and we don't give enough attention to it. Okay, so I'm going to just quickly go through them. On the next slide, I'll explain it a bit better, and then I will direct you to Probe and show you where it's addressed in Probe. First of all is the control environment. That's that environment around your controls. That is that environment about, or the considerations like what's management's attitude to controls. Okay, let's use that as an example. If management's attitude to controls is that, oh, it's just a lot of red tape and we don't really need it and let's just get on with business, I think you can understand this, and you can follow with me, that the control activities are also going to be very lacking, and the monitoring and the system and everything around it. If management's attitude about controls is poor, then you're going to end up with a poor output of the whole process. So that's the control environment. More about that in a few minutes. Risk assessment, that is the environment that management creates, where management constantly assesses what can go wrong in this business. Something that maybe in a small entity is not so significant or not so prevalent. It is there, but you won't find it so formally in a small entity. They're not going to have a risk committee that considers the risks and rates the risks and addresses the risks. You will have to find that in a big company. I mean, in a bank and places like that, you absolutely have to have that. But in a small entity, you're not going to find that. Right, then the information system, always relevant, but not so complex in some entities. The information system, IT, that's what I mean. And then the control activities, more about that later. And then lastly, monitoring. Monitoring is about checking the whole system. Monitoring checks if the whole system works. I mean, because the system is only worth as much as the last time it was operated. So keep on checking if the system still operates as it should do. Okay, so that was just a broad overview of the control components. If we can go into the details of each component, well, not so many details. I'll just show you a few details. And these are the headings that you will find in Probe as well. I didn't pick them up from the standards or from the IFAC guide. In fact, you will actually find a lot of them are in the standards and the IFAC guide, just because Probe is based on that. But this is the basically terms that you will be familiar with. What is the control environment about? The control environment, I've already mentioned, the management's attitude towards controls that you can probably find there. Integrity and values, management style. What is the message that management is sending to the staff members? Is it anything goes, or we do the right thing? We do the right thing. We document it properly. We do it properly. We are careful with what we are doing. We are responsible at what we are doing. What is the attitude? What is the style that management is setting? Or is it, oh, we do everything just for a sale. Let's just get the sales. Let's make the profits and we worry about the rest later. That is part of the control environment. Management's commitment to competence. Do they hire the best people? You know, and this goes without saying. In a small entity, normally they try to hire the best people, but you know, you'll find sometimes that there's someone that's employed because of their connections, or because it's a member of the family, or because we just don't know how to get rid of them, whatever. Is management committed to getting the right people there? A very important one, the director involvement. I'm going to talk a little bit about that later when I talk about small entities. So let's just park that one for a while. The organizational structure. Is the structure appropriate for the entity? What I mean by that is, are there enough levels of management? The structure can either be too complex, so too many layers of management, or too simple, too flat for the particular organization. And that's what you need to consider. It has to be sort of just right. And then everything to do with human resources. Does everyone know what they're supposed to be doing? Do they do what they're supposed to be doing? What if they don't? Is there a policy to follow up on that? Can you see what I'm saying? If these things are in place, if this control environment is in place, it makes our job as auditor much easier. I can almost say if these things are all in place, it actually takes a huge load off your shoulders, because if management worries about values and integrity, and they appoint the right people, and they're involved, and they are responsible, and they have the right structure in place, then as an auditor, we just come right at the end to put the final cherry on it and just check for a few things that they've missed. So we actually don't have to worry too much about it if management, excuse me, sorry about that. If management is responsible and cares about those things. Okay, the next step of internal control is the risk assessment. What process does management have in place to assess the risks of something going wrong? Now, again, in a big entity, you're probably going to find these policies. You're going to find a risk assessment policies, or a risk management policy, or whatever, risk assurance standards, or things like that. Probably not in smaller entities. Once they find those risks, what do they do about it? So let's say there's a risk of the company being exposed. This is quite a valid one currently with our clients. Company is exposed because they have massive foreign liabilities, and with the way that the rand is going and has gone, the company can get into deep trouble. Is anyone thinking about that risk? And maybe, as I say, in a big company, you have a risk committee that considers all of this, and they plot it and they quantify it and all of that. In a small entity, no, you won't have a big risk committee that does it. But I promise you that the owner manager, even if it's just one person, would have thought about his or her exposure to foreign exchange. So talk about, do they think about these risks? What do they do then? Do they identify it? What if someone finds a risk? Do they tell the directors about it? So if someone notices that, oh, there's a door that has been standing open for 2 months now, and there is actually quite some valuable stuff behind that door, do they tell management, guys, I think we should be doing something about this? Does it eventually follow through to the right level of management and probably directors as well? So these are the sort of things that you have to consider under that heading of internal control components. Then the information system. The information system is appropriate to everyone. Some have very sophisticated information systems where the whole business will fall apart without the information system. It's all paperless and it's all computer driven, and ranging from that extreme to the very simple where the client doesn't even have a computer, but they've got a pastel that is run by their accountants, by one of you guys. You run the pastel for them. That is their information system then, and then a whole possibilities in between. Control activities I want to skip just for the moment. I'm going to talk about that in the next 2 slides. And then lastly, monitoring. As I said to you few minutes ago, the control system is only as good as the last time it was exercised. So does it work? Do the controls actually work? The company is supposed to go and check their own controls. Just like you as a firm, audit firm, are supposed to check yourself. How do you do that? You review files. Senior reviews junior's work, and then the partner reviews the senior's work. Why? To see if the senior's approach worked, if the senior's approach was sufficiently robust, they addressed everything, they were well informed, they're knowledgeable, did they address everything? So what are you doing with reviewing? You are testing if your system worked. And the same, the client has to have some sort of review process. And the most obvious one that I think should always be in place is comparing actuals versus budget. Everyone should have some sort of budget, even if it is on the back of a cigarette box, and they should compare the actual results to the budget. And if those vary, then it's reason for investigation. That is a monitoring system that works. Include with that management accounts. I suppose I could have put those two in one box because they go together. Include with that key performance indicators. What does management look at? You have to ask management, or you might not even have to ask them. They'll tell you. What is important to you in this business? Is it gross profit percentage? Is it stock turnover? Is it top line? How many units did we sell? How did the business grow? That sort of thing. What are the key performance indicators? If management monitors the financial performance indicators, the auditor has to be less concerned because someone with a lot more knowledge than us is looking at it already. So that's why the key performance indicators are important. A part of monitoring is insurance. Does a company insure? Insurance will make sure that the risks are managed. And another useful thing is external regulation. Those entities that you have that are regulated, let's say, for example, I'm sure some of you have attorney's trust accounts. They are regulated by the law society that wants them to submit a report every year. If you are from a big firm, banks are regulated by the Reserve Bank. They have to monitor, they have to submit lots of forms, some monthly, some 6 monthly. They are closely monitored by the Reserve Bank. Other regulators, you know who they are. The FSB, if you've got brokers, the the medical registrar of medical aids. A lot of people like that will regulate your entities, and that is going to help a lot because they're almost in a way doing part of our work. So those are the components of the internal control system. However, when we look at components of an internal control system, we normally, or myself, I often tend to focus on control activities. We think that that's the components. Control activities are the specific control activities that are exercised at a transaction level. So let's quickly have a look at the control activities next. In Probe, we have separated the control activities, not separated, categorized, classified the control activities as follows. You've got separation of duties, authorization, physical, result reviews, account reconciliations. So if you look at just an example, I've given you a screenshot there of a probe document. I think it's 1150 or something. That probe document is laid out in that order that you can see there on my screen. Separation of duties, authorization, physical. So let me show you. Separation of duties is over there. Sorry, the screen is a bit small. I'm going to show a probe screen a bit later. Then it will become a little bit clearer. So there's your authorization procedures. There's some documents that's part of also authorization. And then there's physical controls. Okay, and then you scroll down and you see the monitoring, the reconciliation and the reviews. Okay, but we'll show you later in action how that works in Probe. Typical control activities. For any section in the file, you're going to have to look at, is there separation, who authorizes the activities, are there physical controls, basically physical controls over the assets involved in that part of the system, or the documentation involved, are there physical controls over them, lock and key. And then the last two to do with monitoring. Do they review the results and compare it to what was planned? Just a bit more on the control activities. If I can just spend a moment talking about smaller entities. Once again, if we look at these control activities, we tend to think that smaller entities it's not so relevant to smaller entities because they don't have controls. No, not true. Small entities do have controls. Small entities do have controls, but they are much more informal. So the control might not be in the form of 3 people have to sign a certain document, or an application has to be made, or an order form has to be completed in triplicate or whatever. It might not be as formal as that, but the control might simply be the director who's always in his office and he can oversee everything that's happening in the company. That's a control. That's a control. Yes, it is obviously susceptible to management override, but the point I'm making is there are controls in smaller entities. They are just informal and they are undocumented. You're not going to be able to ask the management for his policy on revenue controls or something like that. It's not going to have a policy document. And he might not even have signed. If he checks things leaving the office, he might not even sign it anywhere. He checks it. He knows, I promise you, he knows about everything that comes and goes, but he doesn't necessarily evidence it on paper. Also, the control activities, this is what I find in practice a lot, is that control activities may have limited scope on a small entity. What I mean by that is, sorry, what I mean by that is you've got on probe, you're going to have a section for controls over sales and purchases and salaries and property, plant and equipment and debtors and creditors. But when you come to property, plant and equipment and you try to see what controls do they have in place for the purchase of motor vehicles, you'll see that there actually is no controls because there are no motor vehicles, or there's only like one motor vehicle. So it's not worth putting a control system in place. They never buy and sell motor vehicles, only once every year. So that's what I mean by limited scope. The controls may not cover everything that is covered in a big entity because it is simply not necessary. And in the last point, I cannot overemphasize this point. The control environment itself may mitigate some risks. Can you remember what I said? What is the control environment? Let me just go back to that previous slide. What's the control environment? The control environment is that first heading. And what I did now is I highlighted the aspects of the control environment that may mitigate some risks. For example, in a small entity, there's one director or two directors, let's say two directors, and they are both shareholders, and they've both been friends for the last 30 years. Why are they good friends? Because they trust each other, because they are equally committed to this business, they understand how this business works, and they have the same style. In that case, the fact that they are trustworthy and reliable individuals, they know the business very well, that helps us a lot in addressing our risks as auditors. Okay, now the converse is also true. If you are auditing a small entity and the director is not such a reliable person, you have found a couple of times that they make the wrong appointments, or that they are just not in the business. They are running other businesses, or they are in politics or sports or whatever, everything but the business. That makes it so much more difficult. In fact, it may in some cases become impossible to audit that entity. You may, if you have doubt about these things, management, significant doubt, integrity, values, committed to competence, all of those things, if you're worried about those things, you have to ask yourself really carefully if this company is really auditable. Because if you have such an important person and you have such doubts about the control environment, too much reliance is placed on your audit procedures to find everything. It simply will not be able to find everything. So let's just quickly go through the things that in a small audit may actually help to reduce your risks. I mentioned integrity and values. You have directors there that you know very well. You know they're straightforward, they're honest. Yes, no one wants to likes to pay tax, and certainly not more tax than they have to. So of course everyone's going to try and minimize their tax, but there is a line. If you feel that management crosses that line too often, then you've got a problem. But if management is just simply very aggressive in terms of planning their tax to make sure they pay the minimum, then, I mean, that's what an entrepreneur does. Are they committed to competence? Most of the entities that you work with, in fact, I would say 99%, would always try to hire the best person for the job. If they don't hire the best person for the job, so they take relatives or they take someone who really is not qualified, then you should be concerned as an auditor. But generally, you can put a tick next to this box and say, great, the director is looking after this and he is committed to competence. He'll get the right people involved. If the right people are involved, then us as auditors, our job is made so much easier. Is the director involved in the business? Again, probably 95%, 99% of your businesses, the director is so closely involved, the business is his life, and his life is the business. The director is there all the time, and he knows everything that's going on. That mitigates a lot of my risks, because someone who understands the business very well has looked through all the risks for me. Sorry, I've got some feedback again. Can you just check that you are muted? Okay, it's better now. Sorry, everyone, for that piercing noise. So okay, internet transactions, that's the next one. Internet transactions, very, very convenient. You can pay an account from your cell phone, but just have a look at that. If you're happy with the controls, if it's only a director and there's no other risks, then yeah, it's okay that the director can do everything, create everyone, but don't let the director give his code to someone else and let them do everything without proper supervision. Physical controls, often in a small entity, it's easy because there's one door that needs to be locked. As long as that stays locked, everything is safe. And then monitoring, if you look at that last 2 points, I think we should always recommend that our clients have management accounts and regularly compare the assets to the budget, the actuals to the budgets. Okay, so in terms of explaining to you where everything fits in, that's basically everything I wanted to show. I'm just going to take maybe 5 to 10 minutes maybe 10 minutes to take you through an example in Probe. I've pre-completed some documents in Probe, and then you can see how this is documented in the Probe process, and maybe it'll make a lot more sense to you. Where this process starts in Probe, the Probe starts already in section 1020, where you decide if you want to accept the client or not, and the fraud risk assessment and all of those things. But then at some stage you get to this document, 1051. 1051 is known as types and volumes of transactions. The idea of 1051 is to basically set out on one page what happened in this entity. What sort of, the screen that I've got open at the moment is property, plant and equipment. So, okay, I see it's taking a while to refresh. I just want to give you some time for your screens to catch up. Oh, sorry, I'm on the wrong screen. Sorry, everyone. Now you can see my screen. I was talking to myself for a moment. If you look at that screen, you can see I'm open at property, plant and equipment. So basically the purpose of the screen is to show you what has happened. What property, plant and equipment do they have to have a register, additions, disposals, etc. But what I want to focus on now is right at the bottom of the screen, that question. Sorry, went back to the slide now. Right at the bottom of the screen, that question over there, are relevant to the audit. Okay, relevant. Worry too much about it. It looks like some people have lost my voice. Can you hear me? Can I just quickly check again by show of hands if you can hear me? If you can hear me, won't you just raise your hands? Yeah, some people just complained that they couldn't hear me and sound must have gone missing for a while, but it looks like everyone can hear me, or most people can hear me now. Please just type a message if you've lost it. If you've lost my voice, not if you've lost it, because I think we've all lost it on the last day of February. Look at the last question there. Are controls in this section relevant to the audit? If you say no, controls are not relevant to the audit, then it's not going to go any further. But obviously I'm going to answer yes because I want to show you what the next step is. The next step is to look at the control activities in that section. So I'm going to look at what's open here. Property, plant and equipment is open. Control activities in the property, plant and equipment section. So if I answered no on that previous screen, then this section wouldn't show up at all, because it's not relevant. However, I answered yes. So it means I have to describe the procedure. I have to explain how it was implemented. So that's basically your walkthroughs. Sorry, there's a microphone that has just been switched on again. Okay. See, it's off. If we can, so look at, you have to look at the control procedure, understand it, do a walkthrough, and then decide if you want to rely on it or not. If you're not going to rely on it, move on. You don't have to worry about it. For the purposes of this case study, I'm going to assume that we are doing an entity that's not quite a little owner-managed entity. So it's well, the owner is managing it, but there are other managers involved as well. They buy assets. They've got property. They've got plant. They've got equipment. They've got some furniture, a couple of PCs. They've got a few few things like that. So yes, there are the odd acquisitions. When I say odd, I mean there's not just 5 or 10 acquisitions a year. They may buy a number of assets a year and they dispose of a number of assets. So it's one of a small firms, medium-sized audits, I would think. Then I just looked at one of the examples here. Are authorization procedures in place? So the person here answered yes. Consider authorization procedures. We're just going to discuss acquisitions for now. I'm just going to look at that one section of it. And the procedure for authorization is the only person who ever buys new assets is the managing director. I'm sure it happens in a lot of your businesses where there's a lot of people that do different things, but when it comes to buying assets, the managing director likes to do it himself, or the financial director, whoever that may be. That is the control, and that's a good control. Here you explained then how you determined, that's your walkthrough test. How did you determine that when they told you that that control is in place, that it actually does happen? Remember, I'm not testing it yet. I'm just checking that it was implemented, double checking my facts, basically. And this person here went and reviewed. He asked for one acquisition. So he found that they bought an Isuzu in April. And he just asked him for the documentation surrounding that transaction. And that documentation proved that the director personally wanted to get quotes from different vendors first. And then he signed the offer. And then he signed the finance documentation. And he authorized the payment. And everything was done by the managing director. So we are happy that this control works. There's no problem there. It works and it seems to be efficient, effective if it does work, but we're not testing it. Okay. Then the next decision is now, do we want to place reliance or not? You don't have to. I would recommend it if it's possible, because I think it would result in the most efficient and effective audit approach if it's possible and if it's worthwhile, but you don't have to do it. You can choose if you want to place reliance or not. For the purpose of this case study, I'm going to say yes, because I want to show you where it goes after that. If you wanted to report a weakness to management, you can obviously put a tick there and you can report it. The weakness is typed there and it's flowed through to the management report, but I'm not going to show that now. What I want to show is the next step in the process where we now decided we are going to place reliance on the controls. Let's fast forward a couple of steps to the document where we determine our audit plan and strategy, which is 1220. So 1220 is basically the end result of planning just before you start drawing up your audit programs. You understand what I'm saying? So it's like near the end of planning, just before the audit programs get started. So this document, that section that I've highlighted there, will be pre-completed. That's the only person who buys new assets is the managing director. Pre-completed, why? Because you typed it in the previous section already. It just pulls through here. What will not be completed is this section. You click on it and it comes up with a box that is blank and you have to type this in. I typed this in before the session started just to save some time. You have to type it in to say how you're going to test the controls. In this case, they said select X additions to property, plant, equipment and ensure that they were all authorized by the directors. I called it X on purpose because I don't want to prescribe how many. You must decide how many, and that is going to determine on your firm's policies. Our firm has a policy for high risk, we test so many, and medium risk or low risk, we test so many. You design your own approaches for how many items you're going to test for controls. And it is all in the probe audit manual. Go and look at that and then you can decide how many you're going to test. But you design your test of control here. You should probably just be a little bit more complete than I am. Ensure that they were all authorized by the director. You should say by inspecting the audit document and the finance approval or whatever. Just have more details there than what I had. But the bottom line is you design your test of controls there. Right? What is the next step? The next step is now that we've designed our tests, we can now go and test them, obviously. So for that, you go through... Oh, sorry, let me just show you one more thing. You will see that that box over there, I hope you can see my arrow clearly, is already ticked. So I have a choice whether I want to do extended analytical review or extended detail tests or extended or sampling or whatever. I have a choice as far as those three boxes are concerned. But for test of control, I actually don't have a choice. See, if I click there, it says, sorry, you can't change it because you have indicated that you will place reliance. If you want to place reliance, you need to test them. So you can't take it off. You can't switch it off. Then you have to go back and say you don't want to place reliance anymore. Okay, so that then follows through to the audit program. Audit program is there. If you move your arrow to the top, you see 20.10 is the audit program. So you can just click there and it will open the audit program for you. And if you go to the audit program, you will see that we now have a tab, should normally be your second or third tab, for tests of control. And this is now in your audit program. It says, it reminds you what the control is. The test of control is there. And all that needs to be done is that the audit team must now need to go and carry it out. Be careful when you do this that you, as I said earlier, that you design the test properly. Don't just say, as I say, select XXX editions and ensure that they were all authorized. You must say, get a list of all editions. Ensure that the list is complete by comparing it to the general ledger. Take that list and select the one transaction in each account, or select one in each month, or select 10 transactions, or select 23 transactions, whatever your policy determined. And ensure by inspecting the order form, the invoice, and the internet authorization that they were authorized by a director. You understand what I'm saying? You've got to please be very detailed in this. Why am I saying that? Because that section, that sentence pulls through automatically to your audit program. So the person who has to perform this test must know exactly what they're supposed to do there. Okay, so the last step is to conclude. We found no exceptions, so we conclude here on our test of control, and we can say we can place high reliance on, actually no, completeness doesn't help us much, because the this type of test wouldn't help you for completeness. But for existence, oh yes, definitely. The fact that the director checked everything gives me a lot of assurance. Rights and obligation, obviously a lot of assurance, because if he signed it, he's committed. And valuation, also a lot of assurance, because I promise you, before he signs, he will check it. That's what most people would do. And that is the end of the control risk assessment, and I actually went a little bit further and I showed you the tests of control as well. So that is all I wanted to say today. I got so carried away, I didn't check if there are any questions. So let's just see quickly if there are any questions from you. Okay, can I see, are there any questions? I don't see any more questions. I think we've answered most of the questions, all of the questions. I will stay online for a while. If someone wants to ask any questions, you can post them. I will help you later. If you want to send me more questions, you can email me. Okay. Thank you very much for that. I don't know if everyone heard the last comment I made. I said I will stay online for a while. If you want to ask more questions, I will be around. I see the questions coming through now. So let me just quickly have a look at the questions and then I'll answer them. Yeah, this is a question from Debbie Lee. It is a very valid question. I get it all the time. Thanks, Debbie Lee. And I actually still don't really know how to answer it, but let's try. The question was, on 1150, when will you tick yes, controls on this section are relevant to the audit? Let me just show you what 1150 was. Sorry, I think you're actually referring to 1051. When do you say that controls are relevant to the audit? First of all, try to read the standard. After my explanation here, I want to refer you to the standard. Go to ISA 315. They've got a very good explanation in the application material of ISA 315. Unfortunately, I can't remember the paragraph. I seem to recall something like 24 or something. No, I think I'm wrong. Just look at that explanation when are controls relevant. And then you can also look at the audit guide, the IFAC audit guide. Okay, but let me try and explain it to you. The best way to explain is probably that controls are relevant to the audit if it can help you mitigate some sort of risk in the financial statements. So let's take an example. I am auditing sales of a small owner-managed cash-based company. So it's cash sales, all right? Can you rely on controls regarding completeness of sales And I think you all know more than likely not. There's no documentation. There's significant potential for management override. I'm not going to rely on controls. What am I going to do? Well, what you're going to do is, I think all of us will do an analytical review. You'll start with that. Do a month-by-month analytical review. Perhaps take those months and compare them to the purchases month by month, because that should give you some gross profit analysis. Do some cutoff testing. So I will do all of that. But rely on controls? No, I won't rely on the controls. However, back to Debbie Lee's question, are controls relevant to the audit? I want to tell you, yes, the controls are relevant to the audit, because how do I get my monthly sales? Where do I get my monthly sales from? I will get it from cash register slips, bank deposit slips, the general ledger if you are lucky. I will get it from something that was produced by the company system of controls. So although I'm not relying on that system, those controls are very relevant to the audit. I have to use the outputs of the control system, which is the monthly list or the general ledger or the sales journal or whatever. So in the case of the sales section, the purchases section, the stock section, the salary section, I think you can almost never say no. I don't think sales, purchases, stock, salaries, you can probably not audit that section if there is no controls in place at all. It will not be auditable because you're going to have to redo every transaction. So in those main sections, I would probably always answer yes. I mean, except if the company was dormant, then I wouldn't answer yes to sales. So where I wouldn't answer yes is, for example, in property, plant and equipment, if the only property, plant and equipment is one building. They have one building and we happen to be sitting in the building, so there's no doubt about the existence, and they've had it for 30 years, so ownership is probably not a risk, and we can see the building, it's probably not looking too bad, so valuation is not a problem, and they're not revaluing the property anyway. In that case, I would say controls are not relevant to the audit, so we just move on. But I would almost say go and tick controls relevant to the audit, always, for purchases, sales, payroll, and more than likely stock as well. A next question, also from Debbie Lee. Let's just check. Okay, before I do that, sorry, just go through the questions. It's all of those. Let me scroll down a bit. Right, there's one from Shanae. Thanks, Shanae. For smaller entities, this test of control won't be likely done. It depends what you define as smaller, Shanae. I can think of a lot of my clients that I certainly define as smaller entities where I would do that test. If you are thinking of smaller entities in terms of an entity where there is only one or two or three or four or five acquisitions, then I would agree with you. Yeah, you probably wouldn't do it. You probably wouldn't do it if the acquisitions are not more than, I don't know, more than 20 or so. If it's like 10 acquisitions, you can probably scrutinize through everything and see that they look okay. So I probably agree with you in very small entities where there's very few additions. Shanae, tell me if it answers your question. Otherwise, you can just type more details. I'll scroll down, see if there's more questions. Next question is, where can we get the probe audit manual? You can order the probe audit manual from, sorry, let me just, oh yeah, I'm just trying to ask Christian here, from ProBeta Training. If you go to www.probetatraining.co.za, on their website, there should be a place where you can order publications or something. I know that they have the probe audit manual, and at the same time, if I can do an advert for them, it's now budget time, so I'm sure you've got your tax guides already, but if you haven't, go and look at that from them as well. See any more questions regarding risk? What is meant by medium 1, medium 2, etc.? Yeah, that's a very good question. I actually want to just get it on the screen so you can understand what he's referring to, and that is from Daryl. Thanks, Daryl. medium 1. If you think in terms of the risk, what shall I say, universe, or this range of risk, high, medium, low. We actually in probe, we use the terms maximum, high, medium, low, minimum. Okay, maximum, high, medium, low, minimum. Now, when we start, yeah, that's how it was in the past. We've always had it like that. And then we started to realize that it creates a little bit of confusion because medium is quite a range. You can get medium that's on the high side of medium and medium that's on the low side of medium. And users started getting concerned that they change risk assessment, and it was medium before, but when they change something, they add a risk, it still stays medium. And they think, what did I do wrong? Because it didn't change. In fact, it did change behind the scenes, but it probably went from the low side of medium to the high side of medium. It didn't go into a new bracket. So for that reason, we've implemented this medium 1. Is it medium 1, 2, and 3? Medium 1, 2, 3. 4. 1, 2, and 4. Medium 1, 2, and 4. And the highest one is, and then we have high 1, 2, and 3 as well. So you'll see a whole range. Sorry, I'm not so familiar with the programming, so I don't know what's happening in the background. So you'll see a range of mediums and highs that will indicate to you that will indicate to you what where you are on that level of medium, high, and low. I must say, personally, I never use this. To me, if you say medium, I'm happy. I don't want to know if it's on the high side of medium or on the low side of medium. But it's maybe because I've used the system so long that I know how it all fits in together, and I know that. Don't worry, it will work in the background. You can change it if you don't like these terms. You can change it. There's a firm settings at the top of the file, and you can customize it for yourself. But you don't have to worry about that. So Daryl, I hope that answers your question. By the way, while I look for another question, if you look at the bottom of my screen here, look at the instructions there at the bottom in the blue box, and at 6, click here for a detailed explanation on the calculation of risk of material misstatement. And if you click there, you will get a detailed explanation. I'm not going to show you now because I'm not online, but it's, well, I'm online, but it looks like my internet is not. Oh, it is. There, it's opening. Okay. But you can't see it on the screen. It's off screen. But then it will open and it'll give you a proper detailed assessment, like in a diagram. Okay. Right. Let me see. Do you want me to show you quickly what it looks like while I'm waiting? There you go. Now you can see over there. Just have a look at that while I'm checking if there's more questions. How would it influence your controls, your testing, sorry, question? How would it influence your testing if you say that controls are relevant, but you are not intending to rely on it and therefore not performing tests of controls? If your controls are relevant, but you're not performing tests of controls, then you can't place reliance on tests of controls. So by default, your control risk assessment stays high. Not because the controls are poor, but just because you didn't bother to test them. And that's fine. There's nothing wrong with that. It's going to happen many times that you don't test them, either because it's not evidenced, or because maybe substantive approach is more effective, or whatever. There's many reasons not to do it. How it will affect your testing then is that everything will increase, obviously. For example, if you do a sample size calculation, your sample size will be higher if you can't rely on tests of controls. And those of you that use like probe or something that's a little bit more scientific, not necessarily statistical, will see that your sample size will increase significantly. This has a very high impact on the size of the samples. That's why I would recommend, in our firm, our default is always to rely on controls. Unless there's a very good reason not to rely on controls, we try to rely on it, because otherwise we just get sample sizes that are just much bigger than we believe is effective or than we enjoy doing. So it will impact all your tests. Basically, you can't rely on internal controls at all. Okay, if I'm not Okay, then, okay, Debbie clarified that. She says, rather, how would it influence the probe documents? Okay, let me show you in probe quickly. So if you plan not to place reliance on controls, let me go back all the way to 1150, and I say no. In fact, before I do that, just make a mental note of the screen. Risk assessment, required procedures, conclusion. Okay, make a mental note. On 1150, I now change it, and I'm going to say, no, I don't want to place reliance on the controls. Then, audit plan and strategy will not include the control section. Can you see that's gone? No controls there at the top. The test of control box is not switched on. You can't switch it on either. And lastly, the audit program now looks like this. Remember I said make a mental note of the screen. The screen has now got risk assessment, required procedures, and a conclusion. No test of control. And if you conclude, you will see there in the conclusion, you can only conclude on the assurance that you obtained from required procedures. Your assurance obtained from controls is just not there. It just doesn't appear at all. Nice questions. Thanks very much, everyone. It helps a lot. Okay, just scrolling through to see if there's anything else. Does the probe audit manual include the ISA mapping? Yes, it definitely does. There is an appendix that maps every section of the manual to the ISAs. Every single required paragraph in the ISA is mapped, and in the section of the manual, it again maps it to the probe template. So yes, it does. And also, there's also an HTML version, so it doesn't actually have to be a paper version. You build it looks like a website. You open the website and it shows you the mapping as well. So yeah, that's definitely there. That is a question from Mornay. Thank you. Are there any other questions? Excellent. Thanks very much for your timing. I see it's 2 minutes past 11, so we're not even running over. I'm going to be in this office for a while still, so I actually can still keep the screen on for a while. I'll just switch the microphone off, and then I can just respond by text for the next few minutes. So if you have any questions or you feel I didn't answer a question appropriately, whatever, you're welcome to still post it, and I will try to answer it or refer it to someone. Okay, thank you very much for attending, and all the best. You can see our details there on the previous screen. Let's put that slide up again. If you have any questions, you are welcome. Thank you very much. See you next time.